Good afternoon, everyone. This is John Reardon with the Goodfellow November edition market update. We've got a lot to cover, so I will jump right in. As we start off November talking about the interest rate relief, 30-year fix on a 1-year historical look are just now touching about 6.25%. You could see there back in January, we hit levels of a full percentage point higher at 7.25. So we have been on a downward trending basis. We got as low in some cases of about 6.15 and have revisited those levels since then. This view is of a 5-year view. Again, we are approaching levels of about 6%, but this gives a full perspective on how fast the rate environment has jumped so quickly back in 2022. There's been a lot of talk with the Fed around unlocking the housing market. I'm going to touch on a few examples and really just dismiss that why I believe that these are not necessarily the solution to solve our housing issue. First and foremost, the 50-year mortgage. This has been made a lot of noise in the news publications. In my opinion, the amount of interest that a borrower will accrue over the life of the loan does not correlate proportionately with the amount of savings on a monthly basis. And I think consumers realize that this is not a good solution for consumers. The other discussions I want to have around assumable mortgages, this would be for your conventional borrower. Um, Currently, FHA and VA are the only assumable mortgages available. The only issue with assumable mortgages solving or unlocking the housing market is the amount of spread between the sale price and the current loan amount would have to be made up on behalf of the buyer. And in my opinion, most buyers are tight on cash coming to close and therefore will have some issues with trying to make large down payments to make up this shortfall. Current mortgage interest rates, that touches on the affordability crisis and really just rates are coming down, but they're not coming down fast enough to where affordability is really becoming a relief. Prices are remaining steadily high, and as a result, we're just not seeing that affordability number come down that much, especially when you compare that with those that are currently renting. If you were to rent the same comparable home versus buying, those numbers would be in favor of that rental. And then lastly, the portability of mortgages. So this was an interesting idea, but I don't think it's going to unlock a tremendous amount of opportunity. Yes, there are folks that are interested in selling, they want to sell, but they want to move their mortgage, their existing mortgage and interest rate to that new home. So they would sell in an example, let's say they have a $200,000 mortgage in place, their home's now worth 500,000, they sell, they can move that $200,000 mortgage to their new home that they're purchasing at that existing rate. However, this does not solve for the incremental costs. So would they have to have an additional second mortgage at the new prevailing rate? Or would they have to bring a lot of cash to the table, which could be done if they sold and had a substantial amount of equity? Could this free up some available inventory that we haven't seen in the marketplace? Sure, but I don't think it's the end all be all solution to the housing market crisis. I think, in my opinion, we need to build a lot more and we need to have a lot more inventory hit the market. That's going to come down to rates and really just the supply versus demand aspect. We have a lot of rental units that keep coming online that are getting built, and we don't have a whole lot of properties for sale getting built. There's a couple different theories about this attempt to unlock the housing market. There's a term being referred to as the Great Stay, where homeowners feel almost locked into their current home. And even if they wanted to move, they cannot afford to do so because of a new prevailing interest rate and the cost at which to buy that next home. There's also a large majority of folks that are sitting on a lot of equity. They potentially might sell or are aging, and maybe an empty nester would be a perfect example, but they have a ton of equity in their home. But if they sell, they will have substantial capital gains to pay. And though that capital gains expense far outweighs the opportunity cost of actually moving and getting out from under that property. So what do they do in that instance? Well, they do nothing and they avoid those capital gains year over year. The number of households moving to a different metropolitan area from compared to 2021 are down 30%. So a lot of the movement we saw during COVID has really dried up, and availability has diminished since then. A lot of jobs being just pulled off the market in general, replaced by either layoffs or job cuts or potential efficiencies due to AI in their current organizations or prospective organizations that they're seem to be applying for. And then last but not least, active sellers really just getting frustrated with buyers' offers, and the sellers ultimately are not in distress. And they don't want to take a perceived loss on the property. And I say perceived because they could be netting a large amount of equity still in the sale, but it's not the number they originally intended to sell at. And so instead of settling and selling below their magic number, they're deciding to just pull the listing off the market instead. So let's jump into the numbers. We are looking at a market action index of 44. This on a month over month basis, this is relatively unchanged. And so we are kind of treading water and doing some sideways evaluation at this point. And if you look at that chart on the lower right, market action index, you can see that number has over time increase ever so slightly. We do have more statistics on this on future slides, though. So here is a historical look going back to 2021 to present of where that market action index has traded at. And for those that are not familiar with the market action index, it's basically a barometer that tells us if it's a buyer's market or a seller's market or somewhere in between. At this point, it is a slight seller's market, but relatively neutral. And you see here where we're trading at a 42 or 44, we can see that we are at new levels that we have not seen in the last several years. And since then, that level has been rising ever so slightly. I thought this slide was interesting. This touches on the market segmentation. It basically breaks out the absorption and the days on market between various types of property into quartiles. So you can see at the very bottom of our screen that $800,000 property, which in our area is basically considered a entry level starter home. Hard to believe, but it is. Days on market is just below $50, 50 days on market. As you rise up into that just over a million property, right around 1,500 square feet, you see those days on market increase by about 6 days at 56 days on market. And as we get into more of a higher price property, those at around 4 bedrooms, around 2,000 square foot, or around 1.6 million, that days on market actually drops by a few days at 49 days on market. So we're really not seeing any major relief on days on market until you start getting upwards of the high 2 million plus. So the higher end properties are sitting more substantially than the rest of the market selection out there at about 70 days on market. And this illustrates the 90-day moving average of the average days on market. And again, as we touched on earlier, that's sitting right around 76 days. That's the longest on record of this historical view since we've seen in a number of years. So this is potentially a good thing for buyers, potentially not the greatest news for sellers. Now, here's a view of the current inventory. We are off the 5-year highs, which we once saw early fall, and the inventory levels have been falling, which is not uncommon around this time of year. You see the 7-day average start to lead that charge down. I would presume that towards the early spring or late winter, we'll see this put in a bottom and start to march higher. If that momentum continues, we could see another new year of record high inventory. Again, not startlingly high record inventory levels, but getting back to more of a pre COVID average or above average environment. Price per square foot, we've been averaging about $754 per square foot. It's been relatively trading sideways for a good portion of this year and even late 2023. We haven't seen downward pressure on that dollar per square foot, which really is a good indication of where that kind of bang for your buck is in the market. As that trends down, buyers can perceive that as getting essentially more house for their money. This chart illustrates the percentage of homes actually experiencing a price reduction as it sits on market. Currently, that's sitting at about 33%. About 30% is a standard percentage for San Diego. We do see there were periods back in late 2022, which we saw rise in the 40 or even high 40% range, which is on the higher end. And so we'll be continuously monitoring this. As more price reductions occur, this would indicate market softening or encouraging signs for buyers out there that sellers are finally potentially getting motivated to slash their prices rather than take the property off the market. Speaking of properties coming off the market, here is the percentage of properties that relist. So these are properties that came off the market previously and then relisted a short while after. And so we're seeing this come in at about 21%, which is actually seems on the lower end based on the historical data we show for 21 and 22, and even into the towards the most of 2023. So, to summarize for sellers, as we head into the holidays, typically the holiday season slow down. Really, the motivated sellers only really come out in the marketplace around this time of year. Any active unsold properties typically either sit sale or typically in this time of year we see those properties pulled off the market and then relisted come January 1. For buyers, I didn't forget about you. Only serious buyers typically resurface during the holidays, but those that are out there are serious. And we'll typically see a small finite subset of buyers out there in the marketplace. However, it is a good time to find a relative good value. And I put it in quotations because I do want to restate that, just because I say relative value doesn't mean that these properties are a screaming bargain. Rates are trending lower, but affordability is still a significant challenge in the marketplace. As anyone who has tried to get pre qualified will know how much dollars they can afford with the prevailing interest rate. Um, and last but not least, just to give us some perspective on prices, we see a lot of news making in the news periodicals about prices year over year. Currently, we have basically came off about 4% on a year over year basis from the highs that we have recently experienced. So we're not seeing a ton of price relief out there, but it time will tell to see if inventory rises and buy and sellers are motivated enough to actually start making significant cuts, especially if rates remain consistent. So that is all I had for today's market update. If you guys have any questions or want to talk more about your specific circumstance, I'm more than happy to have a confidential call with you and happy to meet. Give me a call at 858-309-2826. Thanks. Happy holidays, Thanksgiving, and we'll talk to you next month. Take care.